Hey everyone, thanks for taking the time to join me again on Beyond MD for part 2 of the Truth About Permanent Life Insurance with Jeff Bernstein. So I'll give a little warning, this episode is really nitty gritty. So for people like me who like to nerd out, you are going to love it. But I will warn you, do not listen to this when you're going for a run. Instead, grab some coffee, grab a pen and paper, sit down, turn on some classical music. Like what else would you want to do on a Friday night? But we are going to be tackling the various policies and how they go about investing their money and generating returns with an emphasis on the participating whole life policy. So before I move any further, let me give a quick synopsis. Permanent life insurance can be broken down into whole life insurance and universal life insurance. Whole life insurance comes in two main flavors: participating whole life insurance and non-participating whole life insurance. Now, people who hold a participating whole life policy will be participating in a fund that is investing money and is generating returns. So we are going to talk about what types of investments take place here. We're going to be talking about the dividend scales, dividend smoothing, what other factors come into play when understanding returns of these policies. As we will see, there are actuarial assumptions, and there is a bit of a black box here, but we're going to do our best to uncover the lid on this black box. We're also going to be talking about illustrations, why these are or not useful. And then finally, we'll be talking about non-participating whole life insurance as well. This is where policyholders do not participate in the fund I just described, and when this might be a consideration for someone. And then finally, universal life insurance is a policy type where the policyholder can have a bit more say in what they invest in, although that selection is still somewhat limited. And for people like me who like to really understand what their investments are and how they may perform, it's critical to ask about the costs of investments inside a universal life policy. I will admit the information I heard here did surprise me. So without further ado, here's part 2 with Jeff Bernstein. This is the real juicy stuff. So policy investments, policy growth. Some of my questions here may be a little bit direct. This is only because this is what I've heard and I'm just trying my best to get to the bottom of things. But first off, a participating whole life insurance policy, the PAR fund, how does it typically go about investing its money?
Okay. So just as a starting point, with all things investing, as you do such a great job covering in all of your interviews with all of your guests, it's critical to start with someone's risk reward profile and even more importantly, their behavioral profile as an investor. So, and I could ask you what stock would you buy? Like, what do you like buying and owning, and why do you do that? Are you a passive or active type of investor? When we're talking about investments, especially with the PAR fund, so PAR whole life can really be likened to the equities in your portfolio, at least from the insurance standpoint. There's higher upside, yes, but it comes with trade-offs. So it's generally more expensive, whatever. Non-PAR whole life you might want to think about that as a bond. And term insurance, I would consider cash inside your portfolio. Each of them has its own place. It's not an either or proposition, but it's a how much of each and compared to what. It's an allocation. So when it comes to the PAR fund, every insurance company and every PAR fund has its own specific investment philosophy and mandate. As an example, I pulled out some figures from one of the largest Canadian insurers' general account. So not just the PAR account, but their general account of assets. They have close to $200 billion invested. All of their PAR accounts. This company happens to operate in overseas markets, but globally, their PAR accounts represent approximately 1/5 of the assets. So, it's significant. They're committed, it's showing sort of the place of PAR. That particular company's Canadian PAR account sits at around $20 billion. Some companies, who have maybe exited the market in different timeframes, they have smaller accounts. Some are larger, $40-50 billion approaching. Some companies have always been invested in PAR, and others have pulled back and re-entered when the market dynamics called for that. So there is some dynamism and difference when it comes to what you're purchasing in any company's PAR fund. The PAR account itself contains a mix of different asset classes. For each asset class, there's typically a tactical range and a strategic target for how much is invested and in what. Across all PAR accounts from any company, fixed income makes up the majority of par assets, and it's a very substantial majority. So from one company's par fund, I can kind of pull out, they have facts and figures, and we can share with clients what they're buying, what they own. But some of the examples of assets that they might have are public fixed income, so corporate bonds. Private fixed income. In this particular company's case, they tout, hydroelectric, wind, solar energy projects, public infrastructure, things like that. Commercial mortgages, very common. On the non-fixed income side, we see, real estate, public equities, private equities, and some other sort of special allocations for, one-offs. But fixed income is a really important part of this because fixed income is the easiest way to duration match assets of the par fund to the liabilities that are going to be policy owners dying with, and equities are the boost that sort of gives upside to that portfolio.
So Jeff, this is the pitch that we often get. And I'm not trying to criticize anybody here, but this is just what I've heard time and time again, is that the insurance companies this is for par funds. They've been paying dividends consistently for 100 years without fail. But then what I've come to understand from reading and listening to a few other podcasts from some pretty reputable people is that how the par fund performs, the dividend scale, how much dividend you get, basically depends on how that par fund is performing relative to assumptions that were set out by actuaries. And then what I've come to understand is that these assumptions often are not made that clear to us, or in some cases, they aren't disclosed at all. Can you shed some light on this? And then I want to go back to one of your previous comments is that, if the par fund isn't performing in keeping with expectations, then I think you mentioned a zero dividend. Like I didn't know that was even possible. And that contradicts what I've been hearing from some other people in the space. Again, I'm just trying to get to the bottom of it. It's a heavy question, but let's talk about it.
Hey, I'm on your side here, but you'd be forgiven, I think, for being confused or skeptical when it comes to marketing around this and this topic in general. So, the thing I will always say, and I'm not trying to denigrate my industry. I think there's some incredible advisors. There's great advice that's being given out to the public, but many prominent and very highly successful advisors have either misunderstood this terminology or have blatantly misrepresented these facts to the public, including to many physicians. So, Yatin, you're far from being alone in wanting to demystify this topic. And I think it's important that you've, invested in sort of learning about this and sharing that knowledge. So let me start with the dividend scale interest rate, or the dividend interest rate. This is the component that determines the portion of a dividend that comes from investment returns. It is the only but most significant factor comprising the dividend scale that is public, but it does not represent a policy's cash value growth. So while most insurers are marketing now, positive news that dividend interest rates are increasing and most are landing somewhere in that 6 to 6.5% territory, this does not mean that one's policy values have grown or are growing by 6%. The DSIR is a reflection, and we're going to talk about this, of both smoothed returns over the very recent past and a projection of investment returns looking forward in the short term. You asked about this, the dividend, not the negative dividend, but the zero dividend. So it's important for you to understand, and I'm being clear here on the record, is that dividends vest with the policy once they've been paid. At that point, they belong to the policy owner, which is why you'll often hear this particular type of insurance touted for never having a negative position. That's true. Dividends, most insurance companies market that they have always paid a dividend, but it's not contractually guaranteed that they will pay a dividend. So they have some margin for error or margin, to hold back if things, the sky falls. But generally speaking, like, they're crediting dividends. This is what they want to be doing, and they know that it's a really important selling feature of these policies that there is this one out of a very small handful of assets that are truly guaranteed never to be negative in a down market. So that's important to take away.
I guess, is it fair for me to ask then what kind of factors are taken into account? Like when the actuaries are making their assumptions, what kinds of things are they taking into account? And then I'll follow this up by saying, going back to your comment, interest rates are rising right now. So people have been saying, okay, maybe this is a tailwind for returns inside that par account. But on the other hand, I know that there's been a lot of hardship out there, wildfires, a lot of insurance claims. So that, in fact, may be a headwind. I don't know. Maybe this is a bit of a juvenile question, but I wonder if these types of things are headwinds for returns. So that's my question. What factors are taken into account when setting out these assumptions? And then maybe talk about what are some current headwinds and tailwinds for returns in the par account, if that makes sense.
Yeah, great questions. The hard thing about explaining or presenting par to an analytical audience, whether it's here or to my own clients, is that it's typically considered bundled and opaque, right? We know that investment performance accounts for roughly 50% of a dividend, but that means that the non-investment components of the dividend are also 50%, and then that's mortality experience, administrative costs. Policy loan return, so how much a company is actually getting. If you are a policy owner and you go to the insurance company and want to take a loan against your policy, they make money on that spread. That's good for the pool of policyholders. It might be crappy for you because you're borrowing at a high rate, but that contributes to surplus. And then how they're assuming guaranteed versus illustrated, non-guaranteed projected values. In general, with par, the higher the product guarantees in cash, death benefit, or other special features that might, become costly to administer, special benefits that you can draw down on, various things that, expose cash value to, access tax-free, whatever it is, then generally there may be a little less upside to the dividend performance for that policy. As a rule, though, while many insurers offer very similar products in this space, they're not identical. They may be priced with different assumptions, which you've asked about, which we can't know. We don't know. They keep it proprietary. It's a secret. Advisors don't know. We're not actuaries. We try and ask as great questions as we can, but these, the secret sauce details are never revealed to us. And we also don't know, like which change, how much one pays for those same benefits. So, one area that we can discuss is that, mortality assumptions. And I think that that's a great one to discuss with this audience. So as better than most, life expectancy has been increasing for the past 100 years. Remarkably, though, over the last 50 years, life expectancy has actually increased by up to 10 years. And up until about 10 years ago, insurers couldn't assume future improvements to life expectancy reflected in their reserves. We're not going to talk about capital reserve requirements from regulators, but suffice to say, they have to hold back very significant assets to make sure that again, like they're gonna maintain their promises. Their promise is you die, we pay. But that had an impact on dividend scales. So this was also at a time when par as a product purchased in the market was not as dominant as it is now. There's reasons for how that shifted, but it's likely the case that certain carriers, certain insurance companies are actually now reflecting improvements in mortality in their illustrations. Although they're not disclosed at present, these assumptions can make a significant difference to future performance. Again, one of those things that's not comforting for a client who really needs to understand what they're buying, and we understand that leap of faith can be really hard. It's not enough just to say, "Trust us, this is great."
So Jeff, there's the thing though for me. Like I thrive by asking questions and understanding something as much as possible before putting money into it. And so you're saying, like, despite me asking question after question after question, it's still somewhat going to stay a bit of a black box then, right? That's kind of what I'm getting here.
Yeah, I think there are great ways of using math to actually simulate in certain ways which components of these you want to disentangle. So, specific components you can buy. And again, like you can buy those on standalone bases. You can buy, different products that are extremely transparent and that, come with their own, different upsides, downsides, opportunity costs. But when it comes to par, which again is really the the dominant permanent solution in the marketplace right now, that's it. Like we're just sort of staring down this, unfortunate, hey, trust us.
Okay. Your comment about dividend smoothing previously, and also you commented on, well, these insurance companies, despite the par account generating returns, these insurance companies have promises to make. So that probably means that, okay, even though they are issuing dividends, you may not get that 5%, in a given year, because perhaps some of this money has to be retained to maintain other provinces, and therefore the dividends are smoothed. Am I understanding this? Like, can you just I want to make sure people understand the concept of dividend smoothing.
Yeah. Is it okay? I'm just going to address your headwinds, tailwinds question and smoothing. I think I got right after this.
Yeah.
But, for starters, like I'm obviously not an economist nor an actuary, and I'm not in the habit of making predictions other than that I'm going to die one day, which I know, very shocking, right? For an insurance guy. But, so you just asked this. So we know that insurers duration match their investments to their liabilities. So this is really talking about the environment that we're heading into, both, in certain positive elements and attributes for insurance companies, but also, as you said, like very significant, macroeconomic trends, very worrying policy, issues, things that we're dealing with as a nation, whatever. But the insurance companies' portfolios and par accounts are laddered so that their investments are never fully turning over in any one market climate that may be better or worse. We do know that, speaking over the last 8-10 years, the low interest rate environment of those last several years has been challenging for insurers. Many of their investments, we just talked about, are in fixed income holdings. They have to be conservative, which means it was probably a really crappy time to be a bond portfolio manager because they couldn't take advantage of rising, yields and things like that. They had to hold their bonds to maturity. But, so with smoothing, the drag that would have come in investment performance because of smoothing was only slowly passed along to policyholders through dividend crediting rates. These are the things where, there are good news stories, but then there's, well, what does that mean? How did you do that? Like what is that going to mean for me in the future on a 60-year, hold on an investment? So when interest rates shot up dramatically over the last 18 months, we've also seen increased dividend rate announcements from insurers, which suggests at least good tailwinds for par dividends that should probably creep more closely towards long-term averages in the 7 to 8% range. You asked about smoothing, so I'll speak about smoothing now. Smoothing is this notion, and it's kind of specific and unique to par, that spreads out gains and losses over a longer period instead of recognizing them immediately. This is the mechanism that really helps to reduce volatility. Par, in addition to just being considered, dependable, having upside, all those things, the equity version of insurance, it's a low volatility asset, which is helpful for investors who are maybe considering this as an alternative to some of their other fixed income. But in general, because of smoothing, investment returns tend to fall more slowly than actual interest rates and equity markets, but they can also recover more slowly when interest rates increase or equity markets enter growth periods. So this is the dual nature, the idea behind smoothing, and you see all the charts in, our insurance, policy prospectuses, or that, standard deviation of different, different investments, different, comparators, might be off the charts, for someone who has a low threshold for this variability. Par, it's extremely low volatility. It's somewhere, in the 1% range. But that's the idea, is that, in good times, you're not benefiting as quickly, and bad times, you're not going to be harmed as quickly either.
A few podcasters recently had mentioned this concept of, okay, you have the par fund, but then within that fund, there may be these different blocks. And to me, this was a complete shock. I'd never heard about this before. But from listening to their commentary, I was actually wondering, well, does your performance or does your return actually depend on the block that you're placed in? And I'm just trying to get to the bottom of it as much as I can. And do we have any control over this process? What do we need to know about this concept of blocks?
Yeah. I've tried, with your questions, I've tried to really think about why it matters for your listener. And this is a hard one. I mean, there are specific things around this that educators in the space might say, this company is good, this company is not good. But if you think about blocks as different series of policies, closed and open blocks in the PAR accounts came about as a result of demutualization. This is the process of transforming an insurance company from a mutual company, which is owned by policyholders, to stock companies that we know that you can invest in that's owned by shareholders. Many of the major insurance companies in Canada went through this process in the late 1990s. The majority of insurance companies in the country are now, they're stock companies. There's only a few left that are mutuals. When a company demutualizes, the way it works is that it groups all of its participating policies that were sold before demutualization into their own sub-account of the participating account, which is known as now a closed block. Over time, policyholders receive earnings that are generated in the closed block through the dividend process that we discussed. The difference now is that with demutualization is that shareholders were able to start participating in the surplus from that closed block at the time of demutualization, and policyholders now received shares in the new public company. So surplus was basically reduced down to zero. Certain companies, as a practice, and they publish this, they have PAR statements that they're supposed to publish on their websites, but some companies pool their assets for both the open and closed blocks with investment experience that's shared across both. So both blocks have the same dividend scale interest rates. Other companies don't engage in this practice. This is the point that's important to emphasize for your listeners because, obviously, it's important to a client's policy performance that they are going to have decades ahead in an open block with new assets, new money coming in, diverse policyholders with different mixes of ages, genders, socioeconomic status, diversifying mortality and selection risks. Like, we don't spend enough time talking about this. And consumer behavior, which is often linked to many of those factors. It's important that this mix of population is coming into the block, which will also affect policy elapse rates, mortality performance, etc. So the insurance provider that your advisor maybe suggests or selects, they're supposed to dedicate resources to the ongoing management of that open block. So if you happen to end up in a closed or poorly performing block, this would obviously be, a negative for someone who might have invested significant capital and bought into this promise of future performance. It's a hard question to ask because, again, it's not one of those things that no consumer is informed enough to say, am I in an open block? Is the company close my block? Or what are they going to do in the future? What happens if they need to bury a poorly performing fund in this, crummy block? Am I going to end up there? Again, these are some of the things. Ultimately, though, we have this, I think we have a bias in the marketplace to think of, especially insurance in particular, as this evil, awful, they're never going to pay. They're trying to screw us. We're getting screwed as consumers. This is a business and they're good at their business and they're not trying to, take advantage of situations that are going to, penalize, certain individuals, but, there's obviously scope that they have given themselves, as would, pretty much any financial institution, to make sure that, they have some levers that they can control when things don't go exactly the way they need them to.
Thanks for that, Jeff. Okay, the last illustration I was presented with was, I think, quoting maybe a dividend interest scale of, let's say, 5.5%.
Yeah.
So if you were presented with something like that, do you go ahead and incorporate a certain margin of safety? Do you think it's a good idea to knock off 1% or 2 percentage points from that just so we're not setting ourselves up for disappointment? Or do you think that's a fair expected return over the long term? That's one thing I really wanted to ask you. And I think that's the obvious question we tend to ask when we get the illustrations. And then part two is, what other questions should we be asking when we do get an illustration?
I'm so glad you asked this. Okay. I knew you would ask this because you told me you were going to ask it, but what is an illustration? An illustration is, it's reams of ledgers that are like actually meaningless. Like this is the worst part of it.
Yeah.
And this is the way that permanent insurance is presented to consumers, to the marketplace. It's buy this thing on this piece of paper that looks better than this other thing. And here's why, with all these numbers that, I can manipulate to tell a really great story. With some of my comments earlier, I've tried to, debunk that default position to think of illustrations as yielding a specific percentage, right? So although, and it's important for you to know that these are outcomes that, much smarter people than me, product, marketing actuaries, they've tried to reverse engineer using an illustration that predicts, some future state of policy performance. But it's an exercise in fiction. It doesn't mean that what one is buying is built on a house of cards, that it's built on fiction, as some, detractors have suggested. It's not that it's garbage. It's just that it's not the right comparator for, understanding what am I buying. And this, I think, will go to your question. So, I think, and there's a group of advisors, a large group that are excellent at their jobs that promote this. But looking at IRRs, as we discussed earlier, internal rates of return, I think is a more instructive analysis than viewing and honing in on 5%, 6%. And I especially get pissed off when I see marketing from insurance advisors or clients are presented and they're like, hey, we've secured this 6% dividend for you. Your insurance policy values are increasing by 6%. That's bullshit, right? What illustrations are good at is that they demonstrate what might happen to policy values under changing dividend scale assumptions, which again, we don't know how those assumptions have been priced, how exactly the relative weightings have been made by any insurance company, but we can test them. We can crash test them. We can do almost, Monte Carlo scenarios of these policies in different environments. So, for example, if the current projection, the 6.25, was to hold for the life of the policy, or if it was reduced by different degrees, this means that short-term disparities in experience between different par accounts may cause very substantial differences in illustrated values from one company to another. IRRs, on the other hand, can much more objectively be used to compare different insurance policies. And, although this depends on many factors, age, when they bought their policy, how long they invested in it, whatever, any policy that we look at for the most part, when we're looking at the net death benefit IRRs, so we're looking at a payment on death at a specific age, we are seeing, IRRs typically for most of these policies in the range of 4 to 6%. Now, the marketing around this that's tough, it's true, but it's artificial, is that, these are often, they have to be compared to their pre-tax equivalent. That's what makes insurance such a salient, alternative, right? It's the fact that it's the tax sheltered growth and distribution of the money at death. But, we're comparing these to the pre-tax equivalents across alternatives in different asset classes. So if you're looking at an average tax rate of 50%, this is how one might market a 5% after-tax insurance yield, marketed to beat safe money or even risky alternatives that can be anywhere from an 8 to 15% range. So of course, like lots of specifics, lots of nuance there, but in general, IRRs on these are going to be pretty positive. Like these are going to work where they're going to work well. And, we're going to talk about where they fit. But to answer your question directly, Yatin, if you were shown this, this ream of paper by your advisor or someone who says, buy my thing, I would ask, like, why not start with the lower projected illustration and show the upside? What is so like uniquely special about these figures that we have to sell them on, this magical 6-7% number that's going to hold, and as a personal, like firm practice in insurance illustrations, because, a client has to sign off on these. Like if they buy a policy, no matter how much money they're depositing into it, they must sign a sales illustration. This isn't what's going to happen to their policy. This is simply a reference point. It's a benchmark, for future analysis and comparison to see how far off the mark we are. There's usually like a range of, hey, this is the high range, here's the low range. We're going to be somewhere in these poles. But our files always include, whatever the current is, it has to include a -1%, no matter what. But the client file, maybe this isn't information that we, throw into your inbox, but we always document our stress tests of policy performance in the lowest illustrated example possible. And this is frankly like where our wrists are tied by insurance companies, because software only allows us to illustrate whatever current number is -2%. Why this number, and why is this, is this conservative enough? Like, we don't know. Like, we can't know because, Yatin, you're like me. I expect that we're going to live for around 50 years. That's a long time to be making, projections and predictions about things. So it's not that the illustration is indicative of any specific results, or even that the stress testing is to say that, this is what's absolutely going to happen. And that's the benefit of the smoothing mechanism. But it does give that indication of like, what's going to happen to this if those rates fall. We can only control so many of these outcomes, which is why I think good advisors and informed clients want to be asking to build in solutions as conservatively as possible and with as many fail-safes and exit points as possible.
That sounds reasonable, Jeff. Now, we're talking about insurance as an asset class right now. Now, I've heard information from different camps. Some people will take permanent life insurance and say, oh, well, look at the IRR, look at the returns. It's so much lower than stocks in the long run. And other people say, you can't compare these asset classes. Yet, inside the par fund, there are some investments into stocks, bonds, what have you. Like, what's the right comparison? How should we be thinking about it? I compared them. I compared it to stocks in episode 2 when I did a brief intro, and a few people just lambasted me for that. They're like, why? You can't compare the two. But maybe we can. I don't know what the right answer is. What's your take?
Ultimately, in my world, and again, like I'm very clear that we don't do wealth management. We don't try and sell, alternatives, private equities, mortgages. We're not fancy. We're boring. We're plain vanilla. Insurance focused, health insurance, life insurance. We know our lane. So I don't pretend that, just because we have the hammer that, everything is a nail and that insurance is the solution to every single problem. But I think, it ultimately comes down to an allocation question. It's not that, this is better than, it's different than. And, what do you want to be owning at different points in your journey? So, maybe that, 30 something, and I want to talk about where it fits. So we'll go there later, but, maybe permanent insurance isn't the thing that they need to buy now, or maybe they want to just dip their toe in and buy a little of it because they don't need to tie up, their cash flow into this thing that really is optimized properly for an outcome on death. That's really where this thing is going to be, fitting and shining. I think if you want to get into like the nuance and specifics, sure, I could come back and I can say, from a sales standpoint, but and like, show me an equity investment that is going to achieve 16% year over year for the next 40 or 50 years to match, this net benefit to the estate. But it's not a fair comparison. Like there's going to be a place for those investments, and there's probably going to be a place for permanent insurance for, at least a segment of the population where it fits. So it's a bit of a cop out. I know, but
it's okay.
It's not it's not
good.
It's not an apples to apples kind of thing. Like they are different, and I don't pretend that it's better than everything. I just pretend that, or I don't pretend, but if someone is, again, GIC rates, things like that, that's a great time right now. Like fixed income is it's safe. Yeah. It's, 100%. High yielding, all those things, but, it's the taxable nature of these investments that ultimately, sometimes it does tend to be the tail that wags the dog, right? It's the tax tail that wags the choice of where to park those dollars, but that's what it comes down to.
So just so people understand the tax piece. So let's say you're in a participating whole life policy, you're getting these dividends. Those dividends are accruing tax free, right, within the policy, and then you can use them to for paid up additions. That means basically to just buy more insurance, but that part is all tax free, correct?
Yeah, exactly. So growth inside, compounded tax free. Access can be tax free depending on how it's accessed. And up to what limit.
We're going to talk about that in a second.
Yeah.
Jeff, you got to give me a hard stop though. Like how long can you go?
I stop. I'm done. No, I'm good. My back's getting a little sore because I'm standing up. But
I was gonna say your posture looks really good, whereas I look like just I'm hunched over. Usually I stand and record, but I knew I'd get too fidgety today, so I'm sitting down.
I'm training. I'm training for a marathon, and like everything hurts.
Oh man, good for you.
Right now,
good for you.
And I'm just I'm just creaky like a board. So standing doesn't really make any difference either.
Okay. So quickly now, Universal Life UL, you talked about how that is more transparent because you can have say in what the investment piece is going to be, right? But you also mentioned that if the investment inside that, or at least a significant portion of the investment, if it tanks, I think you mentioned that one may have to actually put more into the policy to keep it afloat. Am I understanding that correct?
Yeah, I mean, with UL, it's pretty interesting, and like I won't get into all strategies and things like this, but there are different cost of insurance structures that might be better suited depending on someone's age, whether they're owning this in a corporation or personally, what their risk tolerance is. But as a general rule, you asked this, there's a number of investment options that one can choose from within UL. You can buy guaranteed accounts, boring, kind of like GICs, whatever. You can buy managed accounts that might be including portfolios or index-based ones and others. Typically, these are being offered within like the insurer's specific closed group of proprietary funds, but many of them are also managed by the same managers of better known mutual and index funds, BlackRock, whatever. The challenge again that we find that you asked about is how do you reduce potential volatility in the policy from the fund selection? So this is why at least our approach is to really emphasize with clients that we're not investment managers. We don't do predictions. Clients have to take on the responsibility of making those choices. And we really encourage, if they're working, with an advisor, assuming their wealth is managed by professionals, that these selections are being made collaboratively, and that we review them annually to determine, how they did referenced against, what was projected. Because we never ever want. This is life insurance, right? This is supposed to be the money that you sleep soundly on. You park this. This is never spend money. This is money for the family. Whatever you want, however you want to think about this, whatever idea of this. Insurance is supposed to be that asset that allows you to take risks with your other investments because that the coffers are eventually going to be refilled. Spend your money, make those bets. Don't generally swing for the fences in your insurance contract unless, again, you don't care and you're fine with it either collapsing or the fact that you're going to have to resume paying those mortality charges. The other thing that's interesting, we don't see this now happening with current policies the same way, but I mentioned that we're a 3-generation firm. So I have clients here that are still in their 90s, people who have not died, who have owned these policies for 60 years and older policies. I mean, some of the guarantees they had in there, 4% guarantees, 5% guarantees, on fixed income. So, if they had additional money that they wanted to put in here and just shelter, I mean, sure, 3-4% doesn't sound so great in today's environment, but, in the last 10 years, I mean, this was great. It was amazing. But the other cool thing that it did was that it allowed their policy cash values to, accumulate to a point where they stopped paying for their insurance costs like many, many, many years ago. And, we always ask an insurance company, for what's called like an in-force illustration. We want to see where that policy stands today. How's it looking? So those are things that, older policies, there's gold in those things. I mean, the guarantees, they don't exist the same way today. And, most people discount guarantees because, we've been living in an environment that, we didn't know 6% mortgage rates, right? Over the last 10 years, this is foreign to us. So all of these things are like what's old is new again, I guess.
Okay. Now one index fund that I use myself is XAW.TU. And again, not telling anybody to invest in this. It's just one I've chosen for worldwide stocks outside of Canada to make my life a bit easier. By the way?
XAWTO?
Oh, ZA. I say ZA.
I like that.
Yeah. ZA. It just rolls off the tongue. But the management expense ratio for this is about 0.22%. Now, if I was going to put this in a UL, universal life policy, could I expect the same cost? Because I'll be honest, there are a few people who have released episodes of a similar nature, and they make it sound like the cost of holding even index funds inside a universal life policy can be quite high. And I'm just trying to get to the bottom of it. What's true, what's not?
Yeah, I wish you had those options. No, absolutely not. You're not going to find those types of low cost funds available within the shelf. On like index funds, which will have lower drag, lower costs. You might find options within the mid 1% to 2% range, which obviously compared to what you're looking at is an enormous increase. And that's not even to be said for like managed funds that have 3%, 4%. I mean, four would be really high, but in that 3 range. The trade-off, of course, here, and again, like I'm not justifying these things. I don't price this. I don't really care what someone wants to buy. It's a preference for them and their dollars. But the trade-off I think here is that we'll tell them, it's tax-free accumulation. So of course, your performance still has to net out those fees and after tax and all the fees. Like you got to have something, but the tax sheltered investments in that policy are going to also have a bearing, as we said, on the deposit amount that you are required to put into it.
So interesting. So basically there's like a shelf of certain options, but I can't just go and pick any cheap ETF like ZA and put it into a universal life policy. Sounds like I can't really do that.
No, I mean, it's, and I also I'm not going to speak about, I'm only obviously talking about insurance policies in Canada. The US is a different beast and like offshore company. I mean, we have clients that, are doing, they're asking questions like, oh, I read about this thing. I learned about this thing. Someone told me they're doing whatever. No, Canadian companies are boring. They're more vanilla. They are like, they're excellent. Guarantees are great, whatever, but no, you don't have that level of control to just say, I want to buy whatever I want to buy in the universe, and why can't I? And there isn't necessarily a great reason that I have, but it is what it is, right?
Okay, fair enough. And last question in this part is, when would one be better off considering a whole life non-participating policy versus par? Is it as simple as, hey, you know what, I want some more guarantees and I don't want to participate in the black box, even though it may work out long term? Is that really it, or what other considerations?
Yeah, I think that's the most important consideration. So if someone identifies themselves as just saying like, hey, I learned about all of the options out there, that's great. I don't really care. I love my family. I want them to have some money when I'm dead. I want the lowest cost guaranteed permanent life insurance policy available. Typically, this is a good indicator that a non-par should be one of those options that's selected. And again, this is pure risk transfer, which is more closely aligned with the insurance specialist's traditional primary professional duty to guarantee a family's protection against financial loss. And the other thing I'll say is that non-par has really become a dominant option to purchase guaranteed permanent insurance. Because of, and I know you had a previous episode, but the increasing cost of term to 100 or minimum funded universal life policies, which many people and many of our clients did for many years, the existence of cash values in non-par products, even though they're low, they're not anything that's going to blow your socks off, but it gives more exit options from that program. It's a great solution. The only thing I'll say here, and this isn't to, again, over promote par, but the challenge when viewing non-par versus par as an either or proposition is that, at least based on our reading of the leaves of, past and future, which we really try and avoid doing, but there's certain things that again, like become cyclical. I would ask the question to a client or, to your listeners, like, is it logical to only purchase the guaranteed base and therefore lock in, a 40, 50-year investment at today's rates with no possible upside? This is why generally we don't believe in, it's one or the other. It's a bucket, it's a portfolio approach, right? But for a high earning midlife professional, a physician, like, my God, a great example, right? PAR offers flexibility and options that are vital when you're engaging in long-term wealth planning. PAR is indexing. It's an inflation hedge, which is really the primary reason it makes sense for a decades-long investment. And I think the way to view PAR is not to be overly enthusiastic, but to be a measured optimist. And if you can look at, long-term trends of mortality continuing to improve, and that's a space that, your audience is actually participating in helping to shape that future. If we expect that, there will be moderate continued inflation to expenses, but generally speaking, insurance companies are pretty good at getting expenses down, pooling, whatever, all those things. If we're comfortable that investment markets are going to resume performance closer to their long-term trends, and the client can also afford PAR's higher premiums with some buffers that are built in to allow for, overfunding, underfunding, whatever, then PAR is a smart option for some of that individual's portfolio.
There's a good chance your head is hurting right now. That is a lot of information. It takes time to digest it. Right now may be a great time to go get a glass of your favorite red wine. My favorite red wine right now is called Decoy. It's a Cabernet Sauvignon from California, $30 a bottle at the LCBO, totally reasonable, absolutely delicious. Reach out to me, beyondmdpodcast at gmail.com, if you have any questions or any feedback on this series of episodes in general, or if you want to tell me about what your favorite red wine is. I also have Jeff's email in the show notes, as well as links to our LinkedIn profiles. And so I hope to see you for episodes 3 and 4 on permanent life insurance, which will be dropping next Thursday and Friday. So we will be talking about how these policies are used, and then a few critical pieces of information that you do not want to miss. Guys, I thank you for your ongoing support. If you're finding BeyondMD useful for your financial education, I would be so grateful if you can continue to share it with people in your network. We'll see you next week, Thursday and Friday. Stay well, stay savvy.